Taking on new debt is not always so bad. Sometimes it makes sense to borrow money with a promise to repay the debt, particularly if you're pursuing financial freedom. Borrowing money can be good if you use the money in ways that allow you to build wealth. Conversely, borrowing money can be bad if it depletes your finances and traps you in debt. Borrowing money to buy an appreciable asset is efficient debt, while borrowing money to buy a depreciating asset is inefficient debt. These debts can be good or bad depending on your debt tolerance. Efficient and inefficient debts, for example, are good if they help you grow wealth and bad if you cannot afford their financial burden. In this video, we are going to tell you 5 easy ways to make money with debt. Good debt versus bad debt. The video is going to be amazing, so make sure you stick to the end. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. Most of us were raised with the idea that debt is bad. Debt drags you down. Rich people are never in debt. While that may have been true for our great-grandparents, it's no longer the case. Debt is one of the keys that can unlock future wealth as a property investor. The more good debt you have, the more income you can create. It's important to understand what we mean by good debt and bad debt. Some of your debt might be considered an investment. You may be thinking, how can anything as bad as debt be considered an investment? If you took on the debt to purchase something that will increase in value and can contribute to your overall financial health, then it's possible that debt is a good one. When you use debt to finance things that can be consumed, you're taking on bad debt. It is the kind of debt that creates an unhealthy financial situation. Bad debts can be difficult to manage and may pose a negative impact on your credit score. Carrying large credit card balances across multiple billing cycles, for example, can hurt your credit score and subject you to high interest charges. Never use debt to acquire a depreciating asset, Maudley told CNBC when asked about the best financial advice she's ever received. For the first car after college sort of thing, use the least amount of debt over the shortest time frame you can afford. Cars, vacations, and celebrations should rarely be financed. Houses, business interests, investments, education, etc. can be carefully financed. There are a number of ways to make money with debt. Here are some of the best. Number 5. Use debt to start or buy a business. Got a great business idea but need funds for equipment and premises? Or do you want to buy a franchise in a great location? Although some businesses require only a few $100s to start, many require more than is in your bank balance or savings account. Banks, financial institutions such as Lululend, and government organizations such as the IDC and SEDA offer loans to people wanting to start, buy, or grow a business. Yes, there will be some red tape in the application process, but do your homework and draw up a solid business plan, and you can qualify for a loan at a very low rate. Grow your business, pay off the loan, and in a few years, you will not only be growing your generational wealth into a valuable legacy you can leave to future generations, but you'll also be an inspiration to others. And if you employ staff, you'll be helping others earn an income and grow their wealth, which is also great for the economy. Number 4. Be debt smart. According to the One Life Generational Wealth Survey, 37% of South Africans are creating generational wealth by completing their tertiary education, 25% by buying property, and 24% by starting or growing a business. In most cases, these respondents would have used good debt to finance their dreams for themselves and their families. And you can too. So now that you know how to use debt to grow your wealth, get planning. You don't have to do everything at once or in a rush. Take your time, plan ahead, know exactly how you'll use debt to create generational wealth, and always make sure you can afford the repayments on any loan you take. Number 3. Debt consolidation. Servicing multiple debts is probably costing you way more than you need to be paying in interest and fees. It can often benefit you, for example, to increase your mortgage and use the extra funds to pay off other inefficient bad debt like credit card balances and personal loans. Your home loan repayments may stay the same, but you'll be using its lower interest rate to pay off higher interest debt. Your home loan rate will be much cheaper than the finance rates of your retail or installment sales accounts. But bear in mind that you will be financing these consolidated accounts over the lifetime of the home loan, which is likely longer than the term you may have chosen to finance them over initially. Geldenhuys warns that if consumers use their home loans to settle outstanding debts and store cards, they must be determined to not use these cards again, particularly if they are still paying off the previous debt. She also suggests paying a higher installment on your credit facility than the minimum required by the bank to ensure that you attain your wealth creation goal as quickly as possible. Number 2. Property. Property is a prime example of using good credit for wealth creation, as property owners use the bank's money to finance their purchase, paying off a small portion each month while the property appreciates in capital value. With South African interest rates currently at 7.25%, their lowest rate in 5 decades, now is the best time to invest in property, which is already considered the most solid investment you can make. With the supply of luxury housing outstripping demand, this puts buyers in a strong negotiating position, known as a buyer's market, further enhancing the appeal of property investment. Geldenhuys advises anyone who is purchasing property for investment purposes to make sure that the property is in an area where there will be sustainable capital growth and where there is a demand for rental properties. Potential home buyers should also negotiate the best rate concession from their bank and, if necessary, shop around with other lenders in order to secure the cheapest credit and maximize their investment. Uba Home Loans, South Africa's largest home loan comparison service, can make this process easier by submitting your home loan application to multiple banks, allowing you to compare offers and find the one with the best deal. However, you must understand that property is a long-term investment, not a get-rich-quick scheme. You must be willing to hold on to your property through the dips and troughs, such as we have experienced in the last few years, warns Geldenhuys. Number 1. Margin investing. Investing on margin allows you to buy a higher dollar amount of stock than you actually have money for. For example, if you had $50,000 in your traditional brokerage account, you could leverage your investment and open a margin account. A margin account allows you to put up a max of 50% on the purchase price of a stock. You would have $50,000 in cash, and an additional $50,000 would be loaned to you from your broker. Your $50,000 investment gives you $100,000 worth of buying power. You could use this money and buy $100,000 worth of stock. If the stock price appreciates, then you can pay back the loan and pocket the profit. The negative is that if the equity in your account falls below a certain value, your brokerage firm can issue a margin call. If you can't meet your margin call because you don't have enough funds, your broker can liquidate your entire position in stock, leaving you with losses. Going into debt is not always a bad decision. Borrowing money to advance your goals is an investment strategy that can help you grow your net worth. It may go against conventional wisdom because debt is seen as a downward pull on an individual's finances, but if used correctly and managed appropriately, debt can allow individuals to make purchases they wouldn't otherwise be able to, enhancing their returns significantly. Given the level of risk associated with an investment strategy that incorporates debt, it's important to consider whether this approach is right for you. Speaking to a professional, such as a financial advisor, is highly recommended. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Stay safe, and we will be back soon with another video.